Hi everybody, Dana Sparks, broker of Maximum One Greater Atlanta Realtors, and today's contract tip has to do with why a financing contingency exhibit has nothing to do with the buyer getting approved for a loan. Stay tuned, watch the whole video, and I'll explain what I mean. So, the financing contingency exhibit in the Georgia Association of Realtors contract, we have 3 of them. Actually, we've got 4 of them. And if you want to think about, we have 5 of them. If you are interested in information about the financing contingency in an RE forms contract, I'll do another video tip on that. But today I'm talking about the Georgia Association of Realtors, or GAR, contract tip. I am not going to be talking about the entire financing contingency. That would be here, we'd be here for hours. But I just want to talk about what a financing contingency is and the fact that it has nothing to do with loan approval. So, there is the conventional financing contingency, an FHA loan contingency, a VA loan contingency, a USDA loan contingency, and the cash exhibit, which a buyer could also be getting financing. They are just choosing to not making the contract contingent upon or subject to that financing. So, how did this come up? Dana, what do you mean? Well, 2 questions that have come up recently which prompted this video. Number 1 is, I got a question from an agent representing a buyer. And the question was, see if you can see the pup. The question was, oh my goodness, we're running to the end of the financing contingency and my buyer does not have full loan approval. What do we do? May we extend the contingency? So forth and so on. So the answer to that question is basically no borrower's loan is completely approved until almost you get to the closing table, until the closing attorney gets the what we call the package, the lender's package, with full-blown loan approval. So number 1, that's what prompted me to think about, gosh, I need to go in a little bit more depth that the loan exhibits have nothing to do with the buyer's loan being fully approved. That happens based on the lender, based on what work the buyer has done in advance. That could take a longer period than the buyer and seller put down for the financing contingency time frame in a contract. And I'll give you, stay tuned to the end, I will give you some tips and tricks for you buyer's agents on how to speed up this process to give your buyers, yourself, your co-op agent, and your sellers a little bit of peace of mind. So stay tuned to the end for those tips. But in essence, what it states, well, if you think about it, when you go to closing, all contracts are cash closing anyway. They're all cash transactions anyway. Think about it. At closing, the seller doesn't have to wait 30 years to get their money. The seller gets their money immediately. And in the GAR purchase and sale agreement in and of itself, under the paragraph B2 where it talks about purchase price to be paid by the buyer, it does say purchase price shall be paid in US dollars at closing by wire transfer or immediately available funds or such other form of payment acceptable to the closing attorney. Doesn't say anything about a loan or loan approval or waiting 30 days or 15 days or interest rates or anything like that. It is a cash closing at the closing table for the seller. So what is this all about? Well, what the financing, I'm going to talk about the conventional financing contingency. It states at the beginning, paragraph number 1, and the conventional exhibit is F404. And it says, buyers shall promptly apply for and in good faith seek to obtain the conventional loan or loan described below, such that the buyer can fulfill obligations herein prior to the expiration of this loan contingency. And then you fill in the loan amount, term, interest rate, so forth and so on. It goes on to say that the buyer may apply for a different loan. However, if they're going to be denied, the denial letter must match the loan that was written on the exhibit, regardless of what other loan they work out with their lender that they are seeking in different than the one described below. But let's talk about the actual contingency itself. Basically, well, it says buyer has X number of days from binding agreement date to determine if the buyer has the ability to obtain the loan as described above. And if not, then they have to notify the seller that they can't get approved. So let me break this all down. And that verbiage is the same in conventional, FHA, USDA, and VA. There's a couple of differences on the FHA and VA that I'll get to in just a moment. But in essence, a financing contingency exhibit in a contract is only a protection device for a buyer to protect their earnest money if they cannot convince a lender to lend them the money to buy the house. But it even says they can end up getting whatever loan they see fit. But if they're going to terminate the contract, they have to terminate, send notice to the seller within that agreed upon time frame, and then they have to prove it with a loan denial letter. And then there's all kinds of specifications on the loan denial letter that I've talked about in other videos, and maybe I'll do another video down the line again on that. So again, this exhibit in essence is protection for a buyer. If they cannot, they have so many days. Basically, the seller says, okay, buyer, you have X number of days to convince a lender to lend you money to buy my house. You're saying initially, in good faith, you're going to try to convince the lender to lend you money based on these terms, and those are the terms specified in that financing contingency. Now, through the course of you trying to figure out what you need to do to buy my house based on this binding contract we have, you may determine that there's another loan that is better for you for qualification purposes, for financing purposes, for money management purposes, whatever. However, if you cannot convince a lender to take that risk on you in X number of days, you have to terminate the contract with me. You have to send me notice of termination, and you have to prove it. You have to prove it with a loan denial letter from the lender, but that loan denial letter has to be based on the loan that you said you were going to go seek in good faith. And again, there's all kinds of other things. So if there's no issues and the buyer is going to be able to convince a lender to take the risk on them, to lend them the money to buy this house based on this binding contract, then it takes just about through closing. Sometimes there are extensions of closing based on lenders not getting the job done in time. But generally speaking, it does take that full 21, 30, 45 days for the loan to be completely approved. There's no need to extend a financing contingency if everything is fine. This is just for protection for buyer's earnest money should a buyer have to terminate because they cannot convince a lender to take a risk on them. So now I've got some good news. What are some tips and tricks that you as the agents can do on both sides to help prevent any of these issues and make sure that these financing contingencies go through and do not prevent any delays at closings or any terminations? Well, number one, before you ever work with a buyer, you want to make sure that they go talk to a lender at first. They need to check out what are their options. What is the best way that they can qualify to get a loan to purchase a house? What is the best use of their money? To put it into a mortgage or elsewhere and get a loan? Do they have additional cash? What is their financial situation? So they need to talk to a loan officer. But not only have that just original pre-qualification meeting where they state, yes, loan officer, this is how much I make and this is what my debt is. You want to make sure you want to have that conversation with your buyers, to have with their lenders. First of all, you really want to do everything you can to get your buyers to talk to a lender with whom you have a relationship, that you have a good professional relationship, you have some past experience, you have a good communication with. But that buyer needs to not only fill out an application, you want to make sure that that lender has pulled credit. You want to make sure that that buyer has had a conversation with that lender, the source of their income. Is it W-2 income? Is it 1099 income? Is it W-2 income with bonus income? Sometimes different lenders use that for qualification purposes differently. How long has the person been in a job? Has that file, has that information been looked at more by someone else in the loan approval process, by a processor, by an underwriter, than just the loan originator? The loan originator isn't the one making the decision on how to risk an investor's money into that buyer. So the more things that you can do in advance, has the lender looked at bank statements? The more things you can do that you can get your buyer to do in advance before you ever take your buyer out to look at properties, the better off you are going to be. The other thing is you want to make sure that that buyer has cash. Do they have adequate amount of cash for their down payment, for their closing costs, in addition to moving expenses? And then if appraisal comes in low and they've agreed to, they still want to buy the house, do they have cash to pay difference if they choose to go through with that? Additionally, once you're under contract, you want to make sure the loan officer has a copy of the contract, sees what the contract is. Make sure the lender knows what the dates are. Don't let your lenders end up being responsible for losing your buyer's earnest money because they push it off and don't actually get the file to processing until you're towards the end of your financing contingency exhibit. Or make sure the lender knows what it is that the contract is subject to, so a loan denial letter can match that loan regardless of what loan options might be better. You want to stay on top of the lenders and make sure that they are working on that file, not pushing it off, not taking the financing contingency date or the closing date as a suggestion, but actually working towards those dates. And you listing agents, you too have communication with the lender. If you don't get the contact information of the lender at time of contract, then I would try to get it at time of contract and with a pre-approval letter or something like that, and continue to stay in touch with the lender. Additionally, again, I'm not going to turn this into more of a financing, but there are scores that your lenders can pull in advance that does show all sorts of information on your borrowers as far as their tax transcripts. Do they owe any back taxes? Are there liens? Do they have liens on them that may show up later? Do they have any foreclosures? Did they take out a loan forbearance? There's all kinds of things that your lenders need to look into further than just, yep, this is how much I make, this is what my credit score is, and these are what my outstanding debts are. So, hope this contract tip helped you out. Thank you guys so much for watching. Dana Sparks, broker of Maximum One Greater Atlanta Realtors, satisfying your needs with service, innovation, and education. If you like that video, check out the one here. If you like the content on this entire channel, please click here to subscribe. I try to take even the most complicated of real estate situations and make them crystal clear. See what I did there? Real estate made crystal clear. Thank you guys so much for watching.